In the world of finance, consensus is usually boring. Analysts tend to herd together, predicting slow, steady growth, afraid to stick their necks out. But every once in a while, a major institution breaks rank. They issue a forecast so bold, so aggressive, that it forces the entire market to stop and listen. That moment has arrived. Bank of America, one of the largest financial institutions on the planet, has issued a target that changes the conversation entirely. They are not calling for a modest gain. They are projecting a structural shift. Their analysts see gold reaching $5,000 per ounce. And even more shockingly, they see silver climbing to $65 per ounce by 2026. If you're holding precious metals, this is the validation you have been waiting for. If you are not, this is your wake-up call. But why? Why now? For decades, we have been told that gold is a barbarous relic. We have been told that silver is just an industrial commodity. But beneath the surface of the global economy, tectonic plates are shifting. We are witnessing a collision of forces that happens perhaps once in a century. We have an unconventional policy framework in Washington that is normalizing trillion-dollar deficits. We have a geopolitical realignment where central banks are dumping dollars to buy gold. And in the silver market, we have a green revolution that is consuming the metal faster than miners can dig it out of the ground. This is not just a price prediction, it is a warning. The era of easy money and paper assets is colliding with the hard reality of physical scarcity. Today, on the Financial Coin Historian, we are going to deconstruct the Bank of America thesis. We will tear apart the numbers. We will analyze the liquidity stress in the physical vaults. We will look at the massive industrial vacuum sucking up the world's silver supply. And we will answer the ultimate question: if the system truly breaks, could these prices double again? Could we see $8,000 gold and $100 silver? History says yes. The math says yes. Now, let's look at the evidence. To understand why Bank of America is targeting $65 silver, we must first understand that this is not a standard cyclical rally. In a normal cycle, commodities go up when the economy is hot and down when it cools. This is different. This is a structural shift. The current trajectory of the precious metals complex indicates a multi-year bull market that is supported by fundamentals that did not exist 10 years ago. The unconventional policy framework, Bank of America, IMS analysis places significant emphasis on what they call the White House's unconventional policy framework. What does that mean in plain English? It means fiscal dominance. It means that the United States government has entered a phase where debt is growing exponentially, regardless of whether the economy is in a recession or a boom. We are seeing widening sovereign fiscal deficits that are mathematically impossible to repay in real terms. When a government cannot pay its debts through taxation, it has only one option left: inflation. It must debase the currency to make the debt easier to service. This is the debasement trade. Major institutions like Goldman Sachs and Deutsche Bank are now aligning with this view. They realize that gold is no longer just a hedge against fear. It is a hedge against the mathematical certainty of currency devaluation, the geopolitical fracture. Simultaneously, we are living through a period of persistent geopolitical uncertainty. The freezing of Russia's foreign reserves in 2022 was a watershed moment. It told every nation outside the Western Alliance that their dollar reserves were not safe. The result? A sovereign accumulation of gold. Central banks are buying gold at a pace we haven't seen since the 1960s. They are diversifying away from fiat currencies. This creates a floor under the price. Unlike retail investors who panic and sell when the price drops, central banks buy the dip. They are strategic, long-term holders. They are removing supply from the market permanently. Let's look at the anchor of this rally: gold. Bank of America's US peak target for gold is $5,000 per ounce by 2026. There's a consensus forming around the $5,000 level. Why? The investment demand trigger. BofA analysts noted a critical statistic. To hit the $5,000 target, it would not require a miracle. It would only require a 14% increase in investment demand, similar to the flows we have already seen in the current year. This is vital to understand. We're not waiting for a new, unknown variable. We just need the current trend to continue. The demand is already here. Western investors, who have been late to the party, are just waking up. As interest rates are cut, the opportunity cost of holding gold falls. When yields on bonds drop, money flows into gold. The central bank floor Deutsche Bank projects that central bank demand will reach 153 tons in 2026. This is a massive chunk of the annual global supply. When the official sector absorbs 25% of the total gold demand, it creates a scarcity for everyone else. Gold is breaking its historical norms. It used to move inversely to the dollar or interest rates. Now it rises even when the dollar is strong. Why? Because the buyers are no longer just speculators in New York. They are sovereign nations in the East who do not care about the daily fluctuations of the dollar. They care about survival. But while gold is the shield, silver is the sword. Silver has outperformed gold significantly, rising over 84% year over year. Bank of America's target of $65 per ounce implies a massive upside from current levels. Silver is unique because it is a hybrid. It is a monetary metal like gold, but it is also an industrial metal. And right now, both engines are firing at maximum power. The industrial vacuum. We are witnessing a collision between the silver market and the green technology revolution. Silver is the most conductive metal on Earth. You cannot build a modern green economy without it. Photovoltaics, solar, this is the single largest driver. Solar panel production consumed 161 million ounces of silver in 2023. Despite attempts to use less silver per panel, thrifting, the explosive growth in the number of panels being installed is overwhelming those efficiency gains. Electric vehicles, EVs. An electric vehicle requires roughly double the amount of silver used in a traditional gas car. As the world transitions to EVs, demand skyrockets. The AI surprise. New demand is emerging from AI-related applications and data centers. The chips and connectors needed for the AI boom are silver-intensive. Crucially, this demand is price inelastic. If you are a solar panel manufacturer, silver is a tiny fraction of your total cost. But it is essential. You cannot substitute it. So if the price of silver goes to $50 or $65 or even $100, you will still buy it. You have to. This inelasticity is what causes parabolic price spikes. The fifth year of deficit. While demand is exploding, supply is flatlining. The silver market is on course for its fifth consecutive year of structural deficit. This means we are consuming more silver than we are mining. For the last 4 years, the world has been eating into above-ground stockpiles. Bank of America has identified liquidity stress in global silver markets. Inventories in London and New York vaults are dropping. We are approaching a mathematical limit. You cannot run a deficit forever. Eventually, the vaults run empty, and when they do, the price doesn't just go up, it explodes. Let's look closer at the Bank of America numbers. They have a peak target of $65, but an average price forecast of $56 during 25. What does that gap tell us? It tells us they expect volatility, they expect a spike. The significant disparity implies that the move to 65 will likely be driven by a short-term crisis or a squeeze in the physical market. This fits the historical personality of silver. Silver lies dormant for years, frustrating investors, and then does a decade's worth of moves in a few months. The gold-silver ratio, GSR. Another piece of the puzzle is the gold-silver ratio. This measures how many ounces of silver it takes to buy 1 ounce of gold. Historically, this ratio averages around 69.1. Recently, it has been as high as 107. If gold hits BofA's target of $5,000 and silver hits $65, the ratio would be roughly 77.1. This is conservative. If the ratio were to return to its historical average of 69.1 with gold at $5,000, silver would be priced at $72.50. This suggests that $65 is not a fantasy, it is a mathematically grounded target that assumes silver merely plays catch-up to gold. But what if BofA is wrong? What if they are too low? The question, double again, refers to a scenario where the metals detach completely from the current financial system. This is the parabolic potential, the breakdown of trust. Historically, gold and silver experience their most aggressive rallies, doubling in short order, when the underlying currency system breaks. This happened in the 1970s. It happened in the 1930s. If the current geoeconomic uncertainty escalates into a genuine systemic failure, a sovereign debt crisis in the US, or a total loss of confidence in the dollar, the targets move much higher. JP Morgan exceeds $8,000 gold. JP Morgan has modeled a high-end scenario where gold exceeds $8,000 per ounce by 2028. This would require a debasement panic, where institutional capital flees bonds and equities en masse and rushes into hard assets. V3, 100 plus, silver. If gold goes to $8,000, silver will almost certainly go parabolic. In a true mania, the gold-silver ratio often compresses down to 40.1 or even 30. 1. Let S do the math. Gold at 8,000, ratio at 40.1. Silver price, mark $200 per ounce. Even at a conservative 60.1 ratio, $8,000 gold implies $133 silver. This is the scenario where the physical shortage becomes a panic. Industry needs it, investors want it, and there isn't any left. This creates a short squeeze on a global scale. Analysts note that outlier forecasts of 100 plus are increasingly linked to this physical scarcity narrative. We must remain grounded. What could stop this? Bank of America notes that short-term volatility is a risk. Speculative profit-taking can cause sharp pullbacks. If the global economy enters a severe deflationary depression, where industry shuts down, industrial demand for silver could drop. However, BofA analysts concluded that even if silver demand declined by 11%, it would still be in a deficit. The shortage is that severe. The biggest risk is patience. These structural shifts take time. But the trend is undeniable. The Bank of America target of $65 Powell silver and $5,000 gold is a signal. It is the financial establishment admitting that the old rules no longer apply. They see the deficits, they see the central bank buying, they see the empty vaults. We are witnessing a wealth transfer. Wealth is moving from paper assets, bonds, currencies, and savings accounts that are being inflated away into real assets. Gold is your shield. It is the defensive hedge against the collapse of the dollar system. Silver is your sword. It is the leveraged growth opportunity, fueled by the inescapable demand of the future economy. The double again scenario is not a guarantee, but it is a distinct contingency. It is what happens if the levees break. And looking at the debt clock, looking at the geopolitics, looking at the printing press, the water is rising fast. This is the financial coin historian. The targets have been set. The shortage is real. The only question left is, are you positioned for the repricing of the world?